first started working with Claremont colleges in 2000 with the John Hancock plan that we enrolled back then. So I've been with you guys a while. I'm much older now, and so are my kids. But what we're going to do here, so I've been in the industry for 28 years in long-term care. It's kind of a mission for me because I lost my mom at 61 to Alzheimer's disease. And so the planning and the understanding is really for everybody. Whether the insurance is right or wrong for you, you have to decide that. So I'm just going to give you some really good information so you can make some good informed decisions, okay? So with that, we are with Genworth. We've had a Genworth offer prior, and then they updated the plan design. Of course, they updated the pricing, and they've updated some of the underwriting requirements and things like that. So this is their newly introduced updated group plan. We are going to be enrolling. We like to do this separate of your regular medical and core benefit decisions because people like to ponder this one a little bit longer. This is different from other benefits that you have because you're taking this with you when you go. This is something you're keeping. It's portable. It's going to be directly billed to you. We did that for so that you would never have to unhook from the payroll system to get it to go home with you when you leave. That's where a lot of people inadvertently drop this coverage, so this is more convenient for you. But this is Genworth is the carrier. You can enroll with shortened underwriting from now until the 22nd. The shortened underwriting, we'll talk about that. We'll talk about the plan design, and we'll give you a little bit of a sampling of pricing. And everybody's starting to get emails and some stuff delivered to home, so we're just trying to give you a lot of good information for this. So with that, we'll just jump right in. Why do people purchase long-term care insurance? First and foremost, long-term care costs are not currently covered by your other benefit programs. This is a hole that exists in your financial plan that often people don't find out about until the time comes. And then it's a little bit too late to turn the ship around and change course. So to protect your financial retirement, when you do your retirement planning, you've never put the cost of long-term care in those numbers more than likely. I work with financial planners, I work with major universities, I work with major employers, I've been doing this forever. It's a pretty big number that's been omitted. And it's pretty hard to segregate and just save more for it only. And that would be what you'd have to do if you want to self-insure your long-term care needs in the future. So what I like about planning for long-term care, whether you do the insurance or you actually carve out separate dollars, is you get informed about what it costs, how long it might last, how big the need might be, and you don't panic if something happens because you've made provisions for that. So that's the first thing. The second thing is, as a child of a family member who had severe Alzheimer's, planning this is really important to protect your family. When family members have to get involved in long-term care caregiving, it is a multi-generational problem. Not only does it impact their ability to work and save and function properly in their career, but when they come out of their career, a lot of them end up curtailing promotions. Some people leave the workforce to do this. On average, the caregiver loses about $300,000 in net worth as a result of caregiving you. And that is going to spill over and affect your grandchildren because that affects college savings and other things. So it is important that you understand you're the one that eventually is going to have the need. What is your plan? Who's going to be involved? How will it impact them? So this is an important time to really reflect seriously on these things. You want to maintain choice and control. Everybody wants to start and stay at home, and you can only do that if you've got the money to pay for that and the team of people around you to do that and help you with that. All right, so it's choice and control, staying at home. What are the most common reasons I hear for people not doing this? I think first and foremost, it won't happen to me. Long-term care is going to happen to 7 in 10 of us. And the sooner you get around a plan, the better off you're going to be. This is the same as retirement planning. If you start retirement planning late in life, you're not going to have as good a plan as you would if you start retirement planning earlier in life. It's never too late, but the sooner you realize that it's highly likely as an event in your life and start getting your hand around that, the better off you're going to be. Okay? How about my insurance will cover me? A fair amount of people think that Medicare includes long-term care services, which is a financially devastating misunderstanding. Medicare has provisions for nursing care in lieu of hospitalization, and it's getting tougher and tougher to utilize those 100 days of Medicare. You have to have at least a 3-day hospital stay and then be admitted before Medicare might give you up to 100 days of rehab or home health care. Only while you're recovering. When you're no longer recovering, they cut you off, send you home, or call the family and say, as of this date, you and your family are now responsible for your loved one. Okay? And if anybody's been through this recently, the hospitals now have a new game where they keep you in the ER to try to avoid the 3-day hospitalization. Or even better, I've seen this one where they've actually put somebody in a room but didn't actually admit them. So this is not something that Medicare is trying to do to become your long-term care coverage. Outside of that, there is no coverage under Medicare for long-term care services. Okay? What about my disability plan? You have disability. That's only provided to you during your working years. It doesn't go into retirement with you. If you get injured or ill or unable to work, for those reasons, the disability plan kicks in and covers a portion of your income so you can still pay your bills while you're recovering. But it ends when you leave or retire. It doesn't go into retirement. This goes with you. Okay? What about the government will pay for me? Anybody feeling real secure in that one? I mean, you know, we're not getting that one anytime soon that I'm aware of. And I've been watching for that for a very long time. Again, and there's also Medi-Cal. But if anybody's been through the qualification period for Medi-Cal, it's brutal. It's a needs-based plan. You have to have liquidated and used your financial assets to qualify. It's going to look at your income and your assets. So if you've done a good job of planning, you've planned yourself out of the ability to use Medi-Cal, which good for you. That's what you should be doing, right? But that's a needs-based only plan, and typically nursing home only coverage, not what you want. So that leaves long-term care planning, your financial resources or insurance. A lot of people think long-term care is too expensive. The actual care itself, as we're going to get into in a minute, is pretty expensive. But the cost of the premiums, there's still multiple price points here that might work into your financial plan, and you are better served to have some coverage than to have none, because even when you have some, you're still using somebody else's money instead of yours, which buys you time and allows you the opportunity to properly look at how you would use your assets if you need to complement an insurance plan. So there are different price points. The other thing that's unique about long-term care insurance is when you buy long-term care insurance, the age at which you enter the plan is permanently your age for pricing that product. It is not like life insurance, and a lot of people don't understand that. There's no incentive to wait, because the younger you are when you lock that in, your premiums do not go up because you age. Okay, so that's another reason why we focus on making this information available during your working years. All right, those are some sample rates. So you see the same plan design at 50, that same plan design at 55, that same plan design at 60. So the longer you wait, it's like life insurance, the less you're going to be able to buy, or the more you're going to pay for the same equivalent coverage. All right? Now, how do you qualify to use benefits under a long-term care program? Because this is different. It's not health care. The way that long-term care works is we measure your abilities or needs in terms of activities of daily living, ADLs. And they're listed here: bathing, dressing, eating, continence, toileting, transferring. Transferring is getting from seated to standing or from bed to floor. But a lot of people, when you have bad knees or unstable, need that two-hand grab or need the walker or need a cane. That means you're unable to do that by yourself. When you need help in at least 2 of these items, and a lot of people that need help transferring also need help toileting, also need help bathing, also need help dressing, because stability is stability. When you need 2 of those 6, or you have been diagnosed with a cognitive impairment severe enough that you now need that direction, supervision. It's either or. That's when you qualify to access benefits under the program. And the plan has a 90-day elimination period. All long-term care plans have some kind of waiting period from the day this need is established till the first day you can start drawing benefits out of the plan. It's 90 calendar days under this plan. So for the first 90 days, you are coming out of pocket for any care that you need. Okay? There are plans on the market that you can make that a longer period of time, but the longer you make it, it doesn't necessarily save you a lot of money. And the shorter you make it, it actually ends up costing you a lot of money to shorten that waiting period. So 90 days is the most common elimination period. So from the day that that need is established, let's say it's the first of the month, 90 days after that, you can start drawing benefits out of your plan. Okay? We'll come around to questions too when I get through all this. How does it work? So you're going to have a daily benefit pool of money to use. It's not managed care. So you and your family, working with your doctor based on your needs, will decide what's right for you. You can use this at home, in a nursing home, adult daycare, which now exists, and they're very inexpensive, and so you can go from 8 to 5 and come home and have somebody looking out for you during the working day. You have assisted living. This plan pays for the home, the assisted living room and board and the care that you would need in assisted living facilities. So it's pretty flexible on how you would use the benefits. So the 3 key benefit design decisions that you'll have to make if this sounds like something you want to pursue and at least price out. Has anybody been to the website yet? We've been emailing you. On all your emails, there's a quick link, as you see at the bottom. It's genworth.com/Claremont. Go to the website, tool around in it, because there's a lot of tools out there for you, and you can run your own rates. And you can apply right online. Okay? So there's going to be 3 key decisions that you have to navigate to design a plan. You're going to pick a daily benefit, which is the most the plan will pay out each day. You're going to pick a total pool of money, which is the total amount the plan would pay out over your lifetime. And you're going to pick an inflation protection option so that the plan will grow and stay relevant over time, because you're probably all not going to need this right away. All right, let's talk about each of these one at a time. So first, daily benefits. So cost of care in the United States can vary by geographic region. Of course, the East Coast and the West Coast are more expensive than Oklahoma, but Oklahoma's not. All right, so you pick where you're going to use this plan. No matter where you are when you buy the plan, this plan can go with you anywhere you wish to take it. So you don't have to stay in California to use this plan. But you're going to pick from $100, $150, $200, or $250 a day. All right, and how are you going to decide? So there's a cost of care map on the website that you can tool around and see. So you see the darker areas are where the cost, this is average annual home care, 44-hour-a-week home care. So this is not round-the-clock home care, but somewhere in the $50,000 range per year for home care today. And of course that cost rises over time, like bread, milk, gas, and everything else. So on the low end, $3,600 a month is about $120 a day. $4,200 a month is $140 a day. $4,500 a month is about $150 a day. So you can get a fair amount of home care reasonably priced. Now that cost may vary here and elsewhere around your community here, but these are the averages. So if you want to drill this down and see even more data, this is all on the Genworth website. You can put in California state averages, or you can put in a particular city that's close by. You see all the little asterisks. Those are all the places that Genworth has gathered this cost data. You can put the information in by daily, monthly, or annual view. Does everybody see where that is? Right over here on the left. I would put daily so that you can see how it aligns with the daily cost options we've given you. And then it's going to spit out all these costs in daily numbers for all these different settings of care, so you can get a handle on that. And it can also project out what these costs are going to look like 20 and 30 years into the future. So you can see what that's going to look like. Now for a lot of you, you're going to end up picking a number because the premium is the thing that attracts you, and that's fine too. What this helps you do is level set how far that plan will go, so that when you're doing your financial planning, you know that you might have to pull out some additional money out of your financial plan to complement this long-term care. Does that make sense to everybody? All right? So there's that tool. So the next thing is, well, how long does a long-term care claim last? And it really can vary. The industry has been tracking this data for about 40 years now, and on average, it's around 3 years. But a lot of people have short duration events, and very few, but about 20% go beyond 5 years. It's usually the long dementia claim. All right? So what we've done is given you 2 pools of money. So for each daily benefit that we've designed here, there are 2 pool of money options. If you look down $100, straight down, $100 times the number of days in 2 years is $73,000. $100 times the number of days in 3 years is $109,500. All right, that does not mean that if you pick $100 a day at $109,500, that in 2 years or 3 years you're completely out of benefit. It's all a function of how you draw the money out. If you're not having care every day, your pool of money is going to last longer. If you're not spending $100 every day, your pool of money is going to last longer. Does that make sense to everybody? And these are the starting amounts of dollars before you've factored in any kind of inflation growth. So that's your starting pool of dollars. All right? So you're going to, for each daily benefit, there are 2 pool of money options that you can pick. And on the rate quote calculator on the website, as you're picking these, it's giving you real-time premiums for your age. So you can run through all these scenarios in really fast order. The last decision, so this is just to illustrate, you would take these average costs of annualized home care or residential care, which is a long word for assisted living, nursing care times 3 years, and those are examples of pools of dollars you would be looking at. Does that make sense to everybody? All right, and if you thought your claim would only last 2 years, which a lot of people do, it would be times 2. So it's just kind of giving everybody a way to figure out how far will this plan of benefits go. So the last thing is inflation. You're going to have a couple of choices there. So like everything, cost of care grows. I remember 25 years ago when I was doing long-term care planning in the corporate work site, we were talking about $60 a day benefits as the big number. So it has changed. What this is showing you is what the average cost of a care facility is today in the gray, and what it could be 30 years from now, as it's anticipated to rise at 3% per year. That is about what these costs rise at, which would be the consumer price index for housing and labor, because that's what long-term care is. It's not medical inflation. Your medical plans, Medicare is paying for your medical costs. This is rising for the cost of the health and the cost of the housing. Does that make sense? So you can see that it is going to rise. So along with that, you have a couple of choices. Automatically, you all get this buy more coverage over time. That is automatically built into the plan. What that means is your daily benefit in your pool of dollars does not grow automatically. However, every 3 years, you can add to your original purchase, and you will say yes or no to that offer. It's called a future purchase offer.
Does that amount go up with how old you are?
The cost of the incremental coverage is priced at the age you are at the time each offer is made to you. So if you're 50 years old today, and let's just say for conversation your premium's $50 a month, to increase 3 years from now, it's going to be about a 15% increase, taking over account time, and you're going to be able to grow your daily benefit and your pool of dollars by that 15%, and the cost of just the 15% increase, just that future purchase offer, is priced at the age you are at the time each of those offers are made. You will accept it or decline it. If you decline it, then you kept your original premium, nothing's changed, but your plan didn't change value, so just understand that. If you decline 2 in a row, those offers will stop coming to you. So if you want them to continue to come, you need to take at least every other. Okay? So that's how that works. Everybody gets that. If you want it to grow automatically and not have to be thinking about this, then what I recommend is the 3% automatic growth. I do not recommend the 5% automatic growth because we all know where the interest rate environment is right now. The cost of 5% guaranteed growth on these plans is very high. The market's not paying 5% on your savings account or your CDs or anything else, so that for them to guarantee a 5% growth is going to have a risk charge associated with it. So those get too expensive, but they're available if somebody wanted them. The 3% grows with the cost of care. So with the 3% automatic growth, if you add that, of course the premium's going to be higher. But again, that premium's designed to stay level and your plan value grows. Your premiums are not going to automatically grow. You're starting at a higher premium than if you just took the buy more coverage over time, but your premium's staying level, and every year your daily benefit and your pool of money are growing and compounding at 3%. 3% compounded growth, about every 24 years that value will double. And it keeps going. And even as you're using claim dollars, the remaining balances still keep compounding. So that's how that works. So you make those decisions. So I suggest run it with and without the 3% compounded growth and see how those price tags feel. I don't feel that anybody's going to be comfortable with the 5% compound. And it's beyond the growth that you need. Okay, because nothing's growing at 5%. No, the costs are not growing 5%. All right, so in addition, you have a waiver of premium. This is good to know. So when you finally qualify for benefits, you're not going to be paying premium and receiving benefits at the same time. So once you have met your waiting period and you start to draw benefits out, your premium is waived. Unless you were to recover, which very few people tend to do, as long as you're not recovering, you're still benefit eligible, you're not paying premiums. You have a bed reservation benefit. That one sounds really odd, but what it means is if you have a nice assisted living or a nursing home that you want to be in, and the family wants to remove you for some reason, or you need to be hospitalized, the plan will hold the room or the bed for you and continue to pay. Not all plans do that. So that's important, because if you've got a really nice place, it also would pay that if you want to go on a vacation or a cruise with the family or come home for the holidays. The plan will continue to hold that space for you. You have hospice care. So if it's a terminal situation, Genworth actually waives the waiting period if it's a hospice event. And this plan will pay in addition to whatever medical plan you have in place at the time. Okay? And then you have an international provision, which a lot of plans don't have anymore. This plan will pay up to 4 years of international care, but it is nursing care only. It's very difficult to pair our long-term care system up with the international community. But if you were wanting to leave and live abroad, this plan could also go with you and cover nursing care abroad. So it's very generous that way. You have respite care. This is the one benefit you can access during the waiting period. The plan will pay for someone to come in and relieve your family members for up to 30 days during the waiting period. All right, and then you have home assistance. You can use some of your benefit to make some home modifications, which a lot of families that are staying at home do. They usually put in the emergency medical response. You put in some grab rails. You might have to widen some doorways or put in some ramps. The plan can be used for some of that as well. And then finally, informal family care. This plan's not designed to make full-time caregivers of your family. Really, no plan is. If that's your plan, you probably wouldn't buy the long-term care insurance, because why would you pay premiums if you were going to plan on the family members doing that? But it does provide some benefit. It's 30 times per year at 25% of the daily benefit you chose. So you could reimburse a family member for helping out or coming and cooking meals or doing laundry or doing lawn. There is provision in the plan to do that. One last thing that you can select is called non-forfeiture benefit. This is essentially lapse protection. Most people don't buy this. It's not much of a value. It's a required offer. Here's the thing. You're betting against yourself when you buy a non-forfeiture benefit. You're buying this plan and then saying, I may lapse it in the future. And most people don't tend to do that. Most people that buy long-term care never let it go. If you never drop it and never invoke that lapse protection, you are always paying about 12% more for the rest of your life because you bought that feature. See what I'm saying? Now, the way it works, you would have had to have had the plan at least 3 years. And if after having it 3 years, you decided you were going to drop it, you would not lose everything. You would retain at least a pool of dollars equal to 1 month or the sum of the premiums you paid in. So it's not a huge residual benefit either once you lapse the plan. It is required to be offered. All right, so I'm not a fan of that. It adds a lot of cost. You can buy more coverage instead of adding that, but that's my 2 cents worth. Take it or leave it. Finally, eligibility. So who's eligible? So you as the active employee that's benefit eligible, your spouse, partner, parents, parents-in-law, grandparents, step-parents, adult children, and your siblings and their spouses. Now, you are the only one that's getting the shortened underwriting. Any other family member that's interested gets the same rates per age, but they have to go through the more comprehensive underwriting. Okay? And the other thing about this long-term care program from Genworth, when you are coming through a group plan like this with Claremont, you're also getting unisex rates. Male and female are paying the same rate for long-term care. That is not the case outside of a group plan anymore. The men would pay about the same, and women are going to pay about 40% more. We live longer. We're stout and we outlive the men. And we end up using more claim dollars. I did not say that men don't use long-term care. I just said women tend to live longer and claim longer on average. So it's a distinct benefit to have the group plan and have those gender-neutral rates. All right? So that's how this works. Each person must apply and choose their own coverage. And they will also be directly billed. Now, for you, during this initial enrollment, you will have a shortened underwriting. So 2 health questions, they have sub-questions. The application's online, so you can go and look at it now. Your height, weight, which is fairly generous, and then a pre-existing condition applies. So what does that mean? If you have a pre-existing condition that exists today that causes you to have to invoke a claim within the first 6 months of your policy effective date, that condition would be excluded. I have never seen that happen, but it's in there as a protection to the risk pool. But if you have something that basically the carriers are doing this so that somebody doesn't just come in and start working for Claremont and then invoke a $500,000 claim within the first 6 months of their eligibility on these plans. Doesn't typically happen. But I want everybody to understand that wording. Because you're not going to get further underwritten. You're going to answer those questions, and then you're going to be approved as long as you don't say yes to those things that are on the application, and you're going to move along fairly quickly. Okay? The rest of the family will have to go through, and that is through age 65. So if you're 66 or older and an active employee, you still have to go through a longer questionnaire. And we'll be pulling medical records, looking at attending physician statements, looking at your pharmacy. We all have a digital pharmacy record so they can see what medications we're on. And we also have what's called a medical information bureau because everything's going electronic now. So if you have conditions that you're saying no to, but you've talked about those or been diagnosed for those with your physician, it's on your medical information bureau. Okay, so you want to fill these out as accurately as you possibly can. Now, Genworth's really not doing a lot of parameds. You see that paramedical exam? That's not common anymore, but we do have that out there too. Paramed is if they ask someone to go do a blood and urine draw. That's not common, but that is a potential outsider chance on a fully underwritten application. All right? And those are very common in the individual market when you go out and do your own long-term care planning on your own. So that's how this works.
Are you doing the function cognitive assessments and all those other?
Typically for the older applicants. Okay. okay? And depending on what's in the medical records. That's a telephone call, by the way, typically. And I tell people, if you get a functional call, if you get those calls, do not be drinking red wine right before that call. Be on your best behavior and answer those questions exactly as they're asked. Don't elongate them, don't offer more than they're asking, and stay within the time parameter that they're asking. In the last 2 years, have you? In the last 3 years, have you? So 4 years ago, you did something that doesn't apply. Okay, so I tell people it's really important to stay on task with those calls. If you have a family member that's wanting to do that, or so make sure they understand to be on their best behavior and have some coffee. All right. Again, why act now? Because the younger you are, the more coverage you're going to be able to afford, or the less it's going to be for what you think you want. These things are not going to increase because of that. Probably the biggest challenge we see is as we age, things break down and we get more and more challenged to pass the health questionnaire. That's the bottom line. Okay, so your health is of value here. Do not underestimate the value of good health. It's really important on these products where they can say no. All right, so that's how that works. You've got the family able to apply. The maximum issue age is 76. The price tag for those is pretty high. At best, you're probably looking at the $100 a day, the 2-year pool of money, and no automatic inflation, and that's the best you're going to be able to get for that type of plan. You take this coverage with you. It's going to be directly billed to you, so you do not have to do anything when you leave here. This is going to be coming to you. I recommend automatic bank withdrawals, so it's coming out every month and you're not getting paper statements and it's rolling and you're not messing with it, because if you don't make a payment on time, you'll have a 60-day window to get that caught up, but if you don't, you'll lose it. And it's very difficult to reestablish it. If you lose it after that 60 days, you would have to reapply and start over. Okay? So that's how that works. We've talked about the different decision making, and this is on every email that you guys are getting. The website that's all ready for you. This is Genworth's phone number. You can share that information with family members that might be interested in applying or tooling around as well. And then finally, I just want to give you a couple of other disclosures. So could my rates ever change? Yes. Why and how? All long-term care are risk pool products. They're priced with the best knowledge and best assumption at the time. This is the most modern plan out there on the market, so it's been recently repriced, and the company feels very confident about the longevity of these rates. But if something catastrophic changed in order to be able to pay claims, it's a bittersweet news to get a letter from the carrier saying we've got to adjust your rates. They don't just pick a group, they don't just pick an individual, they look at the risk pool. And they file and have to get approval from the state where your policy was issued first. So they have to go through an entire actuarial discussion with the state of California, which is never easy. And then the state of California would have to approve it for them to offer it to you. Would you like that? No. Is it highly likely? Possibly, yes, sometime in your lifetime. Would you not want them to do it? No, because you want them to pay your claims later. That's how they keep reserves adequate and ensure that everybody's got adequate reserves down the road, is that ability to adjust if they were to need to. I have an old John Hancock plan, and I've been hit twice. The John Hancock plan for Claremont colleges has, the state has declined the rate increase twice to the California insurers. So you want them to do it if they need it, you're not gonna like it. That's how that works. There are some exclusions. There's all kinds of good information on the website. So that's kind of where we're going to end the presentation. So we'll stop there and we'll do Q&A. So if you don't have any questions, you're free to go. But I strongly recommend that you get out and start tooling around. If you have questions, I'm going to stay till they're all answered. All right? So hit me with your best shot.